Hi, in this PSHE session, we are moving onto a section all about finance. And I wish this is something that I learned more about at school because I've had to learn this the hard way. So hopefully over the coming sessions, you will have a better understanding of the world of banking, financing, saving, pensions, all those things that will set you up well for life beyond school. So hopefully you've watched the video about the poet talking about giving you the edge. What are the things that you can do to give yourselves the edge? Now, in our session today, we're going to look at different types of accounts that exist and look at some of the pros and cons about them. And we're also going to look at which products you might need to know about in the immediate future, such as bank accounts, student loans, mobile phone contracts, saving accounts, and then later on in your life, pension schemes and insurance. It's good to have an understanding of what these are. You'll also be able to choose and work out the costs and benefits of various products that you might need now. And we're also going to look at how you are responsible for working out which financial product might be best for your situation so that you can go into this with a full understanding of the small print before you sign up to something. And my general rule is that if it looks too good to be true, it probably is. So to get us started in this, I would like you just to get out a rough piece of paper. We're going to do a multiple choice question quiz, and you simply need to write down the correct letter. Okay, so our first question. When you borrow money, you have to pay back A, nothing, B, only the money you borrowed, or C, the money that you borrowed plus interest. Did you get C? Absolutely right. Nothing is for free. Number 2, the yearly interest rate is A, a percentage which controls how much interest is added to your debt every year, B, a percentage which controls how much interest is added to your debt every month, or C, the rate you pay when you change money on holiday. Well done. A, it is the percentage which controls how much interest is added to your debt every year. Question number 3. If a loan comes with no extra charges, the APR is the same as the weekly interest rate, the same as the monthly interest rate, or the same as the yearly interest rate. Well done. If the loan comes with no extra charges, the APR is the same as the yearly interest rate. Question number 4. If a loan comes with extra charges added on top of the interest, the APR is the same as the yearly interest rate, A, B, higher than the yearly interest rate, or C, lower than the yearly interest rate. Right, it is in fact higher than the yearly interest rate. Now, you might one day get a loan for a car or for going to university, so really important to understand this. Number 5, if you borrow money on a credit card, you can reduce the cost of borrowing by A, paying the debt off slowly with small payments, or B, paying the debt off quickly with large payments. Well done, quite right, it is B. And a credit card is very, very easily to accrue lots and lots of debt over time. And the interest rates are very often really, really high. So you're better off paying it off at the end of each month so that you're not paying extra money towards the bank. What type of loan would you normally use to buy your house? A payday loan, a credit card, or a mortgage? Well done, it's obviously a mortgage. So a payday loan is what sometimes people get if they don't have enough money to get to the end of the month. They take out a payday loan, which often has the most extortionate interest rates and could lead to you being more financially in debt. So very, very dangerous. A credit card, we've discussed that, and of course a mortgage is what we use to buy a house. Question 7, what is a typical yearly interest rate for a mortgage? Is it 3%, 20%, or 100%? Right, so this does vary, but it is typically 3%. What is a typical yearly interest rate for a credit card? Is it 3%, 20%, or 1,500%? Right, it is actually 20%, so 20% on top of what you have spent. How long does it typically take to pay off a mortgage? Is it 1 month, 3 years, or 25 years? It is a long time. It is 25 years. And number 10, after how many years does the government write off unpaid student loan debt? Is it A, 10 years, B, 20 years, or C, 30 years? The answer currently is 30 years. Okay, so what do you already know about financial products? Do you already have any of them? Do you think you choose the right product? Who or what influenced your decision? So, just to start thinking about this topic, this is going to give you a bit of an overview. So on the screen, you can see a range of financial products from current accounts, savings accounts, student loans, insurance, mobile phone contracts, pensions, bank loans, credit cards, and mortgages. Current accounts and savings accounts. What's the difference between the two? Current accounts is normally what your salary gets paid into. It lets you track money you receive and spend. And you can set it up to pay bills automatically. So perhaps one day this will allow you to pay for any direct debits for furniture that you've bought, or your bills such as council tax, etc. Many current accounts come with a debit card, which you can use to get your money out of cash machines. Current accounts usually give you instant access to your money, so you can take money out without giving notice or being charged. Savings accounts usually pay more interest than current accounts, and it's usually worth shopping around to get the best deal. But they might have more restrictions. For example, some of them require you to give notice before withdrawing money. You often see interest rates written as AER. This stands for the annual equivalent rate, and lets you compare the interest rates of different savings accounts when fees, bonuses, etc. have been taken into consideration. You can choose between accounts that you manage online, over the phone, or at a bank branch. Now, student loans might be important, costs at least £9,000 to get onto a university course. And it says there student loans can help pay for the cost of higher education courses. There are loans for tuition fees and loans for maintenance, such as your where you stay. You pay back the loan when you finish the course and you are earning over a certain amount. Another type of loan is a mortgage when you buy a property. So bank loans are offered to customers to buy things like a car, doing a home improvement, even holidays, or starting a business. The bank checks the customer can afford to repay the loan, and then they agree the amount, the term, which is the deadline for repaying the loan, and the interest rate, the charge for borrowing the money. Credit cards are plastic cards that allow you to buy goods immediately and pay for them later. If you don't pay back the total amount by the due date, you are charged a lot of interest on what you own. A store card is a type of credit card that you can only use with a particular high street chain. When you get a mobile phone, you can either get a pay-as-you-go plan or you can take out a contract. With pay-as-you-go, you buy the phone upfront and you pay regularly to use it. With the contract, you're tied into paying a monthly amount for a period of time, such as 24 months, and you get a bill each month. The cost of the phone handset is part of the monthly payment, and you might be charged more if you go over your call or data allowance. You're charged a fee if you leave the contract early. Pensions are offered through the government, such as a state pension, or through your employer, a workplace pension, or through a financial institution. That's a private pension. State pension is paid to people who've worked and paid national insurance contributions for a certain number of years, or who've been unable to work. The government sometimes changes the rules about who gets a state pension, how much and at what age, so it's best not to rely on receiving one of these when you retire. With workplace pensions, both you and your employer pay some money into the pension each month. With personal pensions, the financial institution invests the money with the aim of increasing its value. When you retire, you can choose to receive your pension all at once or bit by bit over a period of time. And then there's insurance. Insurance is a way to avoid the risk of having to pay a lot of money if something unexpected happens. So it could be home insurance, car insurance, or travel insurance. And you pay regular payments, called a premium, to an insurance company, and it covers the cost if you have a big expense. For example, a car insurance company might replace a car if you are in an accident. So here's some saving accounts tips. Use AER to compare interest rates of lots of different savings accounts. Think about how quickly you would need to access your money. Would you need it instantly or could you give notice? You sometimes get higher interest rates if you can lock your money away for a period of time, so worth talking to your bank about, especially if you want to save up for something like a car. So some savings, like cash ISAs, let you save a certain amount of money tax-free. Watch out for early withdrawal charges. Weigh up the benefits of any incentives offered for savings accounts against the interest rates they offer. So I hope that this has given you an overview. I don't know if you do have a bank account. Perhaps your parents have set up a savings account for you that you perhaps put some birthday or Christmas money into. Perhaps there's something in particular that you are saving money for. It's really wise to ask questions before you take up a financial product. So be financial wise and have a good day. Take care.